Imagine this. You've made student loan payments for 20 years. You finally hit forgiveness. Then, a few months later, and it is for $10,000.
All right, let's dive right into this explainer. We're looking at a fast-approaching 2026 financial threat that honestly, almost nobody is talking about right now. We spend a ton of time focusing on how to get student loans forgiven, but what actually happens the day after that forgiveness is finally granted? Today, we're going to break down the mechanics of the student loan tax bomb. We'll explore exactly why your forgiven loan could suddenly be treated as taxable income, how much that might actually cost you out of pocket, and, most importantly, we're going to uncover a specific IRS rule that could legally wipe out that entire tax bill. So let's get into it.
Okay, I want you to imagine this scenario. You've been diligently making your student loan payments for, 20 long years? Check your account, and boom, you finally hit that magical forgiveness milestone. Your remaining balance is completely gone, zeroed out. You think you're finally free from the burden, right? And then, just a few months later, the IRS sends you a surprise bill for $10,000. No way, right? Well, this isn't just a scary hypothetical. Starting in 2026, this exact sequence of emotional whiplash is slated to happen to thousands of borrowers.
So, to understand why this is happening, we've got to look back at the American Rescue Plan Act of 2021. As a temporary pandemic-era relief measure, this act did something absolutely incredible. It made student loan forgiveness completely tax-free. If your loan got forgiven during that specific window, you owed the IRS absolutely nothing. Zero. But because it was a temporary provision, it came with an expiration date. It legally expires on December 31st, 2025. That means starting January 1st, 2026, if your loan is forgiven through an income-driven repayment plan, like the IDR or the RAP plan, that temporary tax shield is completely gone. And here's where things get tricky. The core of the problem comes down to an IRS classification known as cancellation of debt income. When that temporary tax shield drops, the IRS essentially treats your wiped-out debt as a massive bonus check. Just let that sink in for a second. The IRS considers your canceled debt as actual income and they are going to tax you on it. And this applies even though you never actually saw a single cent of that money deposited into your checking or savings account. It's basically phantom income, but let me tell you, the tax liability attached to it is very, very real. Let's look at the math to see how this actually plays out in the real world. Say you're a single borrower and you earn a salary of $50,000 a year. You've been on an income-driven plan for 25 years, and eventually, $40,000 of your remaining loan balance gets forgiven in the year 2026. Because of that cancellation of debt income rule, that $40,000 gets added directly on top of your earned income, so suddenly your taxable income for that year violently jumps from $50,000 all the way up to $90,000, potentially pushing you into an entirely higher tax bracket.
So, what does that jump actually cost you? Well, according to data from Protect Borrowers, a borrower in this exact situation, bumping from $50K to $90K in taxable income, could owe an additional $9,000 in extra taxes. And here is the kicker, the really tough part. That extra $9,000 is due at tax time in a single lump sum, which is exactly why they call it a bomb. Depending on state taxes and a few other factors, it could sometimes be even more. I mean, that is a devastating blow for someone who just thought they had finally achieved financial freedom.
And what makes this impending tax bomb so incredibly dangerous is who's standing right in the blast radius. Most people dealing with decades of income-driven repayment are not high earners. In fact, according to consumer data, a massive 62% of borrowers receiving IDR forgiveness make $50,000 a year or less. And to make matters even tighter, 2/3 of those individuals have less than $1,000 in savings. Think about that. The people most likely to get hit by this massive tax bill are the exact same people who can least afford to pay it. Now, before you panic and assume the absolute worst, we really need to establish some safe zones here. Not every single type of student loan forgiveness is going to trigger this tax bomb. It's incredibly important to figure out exactly which type of forgiveness program you're actually enrolled in, because that alone could save you from a whole lot of unnecessary stress. Let's take a look at who's protected.
All right, so if you are working toward public service loan forgiveness, commonly known as PSLF, you can breathe a huge sigh of relief. You are safe. Unlike income-driven repayment, which is protected by that temporary pandemic law, programs like PSLF are protected by permanent statutory tax codes because they're directly tied to public service. That specific forgiveness remains completely tax-free, permanently, by law. And the same goes for teacher loan forgiveness that is also permanently tax-free. Forgiveness granted due to death or total permanent disability also remains tax-free. The tax bomb strictly applies to forgiveness through those income-driven repayment plans where balances are wiped out after 20 to 30 years of payments. But What if you are one of the millions of people relying on an IDR plan? Well, here is the absolute crucial point of this entire explainer. There's a rule hidden deep in the tax code that financial experts use to protect their clients. It's a mechanism that could legally wipe out your entire tax bill and save you thousands of dollars when your forgiveness date finally arrives. It's known as the insolvency exclusion. So what is it? The insolvency exclusion dictates a very specific mathematical rule. It's essentially a strict test of your net worth on the exact day of your loan forgiveness. It states that if your total debts are greater than your total assets at the very moment your loan gets forgiven, the IRS allows you to legally exclude some or potentially all of that forgiven amount from your taxable income. Essentially, if your liabilities outweigh your assets, the IRS acknowledges that taxing phantom money is kind of like trying to get blood from a stone. Let's move to a hypothetical and see how this builds out in practice. Imagine we take a snapshot of your finances the very day your loan is forgiven. On one side, we add up all your assets, your savings, retirement accounts, the value of your car, basically anything of value you own. Let's say that totals $60,000. On the other side, we add up your total debts. This includes credit cards, mortgages, and this is a really important detail. The student loan itself is counted as part of this debt load before it gets wiped out. Let's say your total debts add up to $145,000.
All right, because your debts of $145,000 exceed your assets of $60,000, that creates an $85,000 insolvency gap. And that number, that is your golden ticket. It means that you can exclude up to $85,000 of forgiven debt from your taxes. So, if your forgiven student loan balance is, say, $70,000, which is safely below your $85,000 insolvency gap, your entire tax bill on that forgiveness legally disappears. You owe nothing. And remember, I want to be clear here. This isn't some shady loophole. It's a completely legal, standard part of the tax code.
But you knew there was a but, right? Here is the catch. The IRS does not do this math for you automatically. To actually claim this life-saving exclusion, you have to actively file a specific document called IRS Form 982 along with your tax return. On this form, you'll list out your exact assets and your exact liabilities to prove your insolvency to the government. You need to be really meticulous here because doing this incorrectly or just guessing at the numbers can trigger an IRS audit. This is precisely why financial experts say most borrowers end up owing far less than the scary headlines suggest, but you absolutely have to know the rules of the game to play it safely.
So let's build your action plan right now if you're expecting IDR forgiveness in 2026 or later. First, you need to find your exact timeline by logging into studentaid.gov and pinpointing your projected forgiveness date. Second, start saving now. A really solid conservative move is setting aside 25 to 30% of your expected forgiveness amount, just in case. Next, calculate your insolvency gap today so you know exactly where you stand. When the time actually comes, do not throw away Form 1099-C when your servicer sends it. You literally need it to file. And finally, consult a tax professional before your forgiveness date, not after. Getting out in front of this is absolutely everything.
So, here's the reality. Student loan forgiveness is going to be taxable again starting in 2026. That temporary shield is dropping. But as we've seen today, that doesn't mean you have to be a casualty of the system. Between safe zones like PSLF and the incredibly powerful tool of the insolvency exclusion, there are legally sound ways to protect your finances. So, the final question you really need to ask yourself today is this. When your forgiveness letter finally arrives, is it going to be a financial trap that catches you off guard, or are you going to be fully prepared to defuse the bomb?
Subscribe to this channel for more such valuable videos, and hit that like button if you genuinely liked the video, and comment for more suggestions.
वीडियोस बनाने हैं, फिल्मोरा है ना।